My name is Martina Tessari. I'm Head of Europe at A4S. Thank you for joining our webinar on sustainability reporting today. Please note we are recording this webinar for others and it will be made available on the A4S YouTube channel afterwards. And throughout the webinar, please use the chat box to post any questions or comments that you may want to share. We will do our best to answer those questions as we go through the busy list of today's agenda. Or in the Q&A session at the end if we've got some time left. The learning objectives of this webinar, after completing today's course, you'll be able to articulate the benefits of efficient and effective reporting standards and frameworks, identify the appropriate tools and knowledge to tackle sustainability reporting, and translate the experience and learnings of others from practical examples shared during the webinar to your work. Moving on now, I wanted to turn to sharing with you all an introduction on how the reporting landscape looks today. While business performance has historically been measured in financial terms over the past 2 decades, reporting requirements have been changing rapidly. Societal awareness and of environmental and social issues is obviously increasing, and as a result, stakeholders are demanding a wider range of information with a clear global trend towards mandatory sustainability reporting. There are currently more than 600 sustainability reporting requirements across 84 countries, and 25 exchanges require ESG reporting as a listing rule. If we go to the next slide, we should be able to see how much this is spread across the world, really. Organizations are therefore relying on their knowledge, the skills and processes of even finance professionals and accountants to get ahead of corporate reporting trends. And I would like to mention the most important ones today. So on the next slide, you see a few logos and a few you may recognize. So starting by the Global Reporting Initiative, or GRI, which produces the GRI standards, which are designed to be used by organizations to report on their impact on the economy, the environment, and or society, and communicate on their impacts, and both their positive and negative impacts on sustainable development. They help organizations prepare a sustainability report based on the GRI reporting principles and focus on material topics that are intended for a multi-stakeholder audience. So this is a very key concept under the GRI. The GRI standards are relevant to companies, accountants, investors, capital markets, and policymakers. And we will hear more about GRI from Elodie in a little while. Moving on to the Task Force for Climate-Related Financial Disclosure, also well known as TCFD, that was an idea sparked by an event organized by A4S and attended by His Majesty the King in his previous role as the Prince of Wales, and Mark Carney, the former governor of the Bank of England. The TCFD was then set up in 2015 to develop recommendations for organizations across the world to disclose information about their exposure to climate-related risks. Now, the disclosures recommended by the TCFD have received significant support through a market-led approach to development and adoption. And we've seen on the poll just now, it's very common framework being used. Increasingly, they are being mandated by regulators and governments in different countries. They are also informing the development of climate-related standards by the I4S Foundation as part of the International Sustainability Standards Board, which we'll discuss further in just a moment. Worth mentioning the World Economic Forum, the WEF, that published a set of common metrics and disclosures developed by the Big Four accounting firms with support from members of the WEF's International Business Council. Measuring stakeholder capitalism was developed to help companies begin reporting in a consistent and more comparable way on key dimensions of sustainable value. And as a key way of achieving those goals, the recommendations promote the use of existing standards, in particular the GRI, TCFD, SASB, rather than creating a new set of metrics. And taking these standards as a starting point, the recommendations propose the adoption of a common core set for companies to adopt. The Sustainable Development Goal disclosures recommendations attempt to establish a best practice for corporate reporting on the SDGs and enable more effective and standardized reporting and transparency on climate change, social and other environmental impacts. The SDGD recommendations offer a new approach for businesses and other organizations to address sustainable development issues aligned to the most influential and popular reporting frameworks. So again, GRI, IIRC, and TCFD. But then I guess building on the theme from these last two, which attempt to build on existing work or reach an increasingly standardized approach, the last 15 months have seen a rapid acceleration in terms of progress, and within that, consolidation in the sustainability reporting space. The key outcome of this is the launch of the ongoing work of the International Sustainability Standards Board, or ISSB, part of the IFRS Foundation in November 2021. The ISSB was formed also through the mergers of the SASB, Sustainability Accounting Standards Board, and the International Integrated Reporting Council, IIRC, which was again an initiative founded by IFRS and the Climate Disclosure Standards Board. Now, in March last year, the ISSB issued 2 proposed reporting standards on general requirements and climate requirements, probably worth moving on to the next slide. With a focus on disclosure of information material to enterprise value investors. The exposure drafts underwent public consultation during the summer, and finalized standards are expected by June this year, ready to be adopted and endorsed by jurisdiction for the reporting year 2024 already. So quite a paced environment. In December, the ISSB announced proposed rules aimed at considering the connection between climate and nature, including one with the goal of cutting companies' negative effects on biodiversity up to a half by 2030, in line with the outcomes of the United Nations COP15 Biodiversity Conference. And we'll hear a bit more about efforts towards biodiversity reporting shortly by Elodie. In 2023, the ISSB will also look into potential new disclosures around the impact of businesses on not just biodiversity, but also human capital and reporting on human rights within companies. Of course, the ISSB success will rely heavily on global adoption by individual countries and jurisdictions. And in light of these international developments, we should touch very briefly on some regional ones also to understand progress today. So on the next slides, you'll see we mention what's happening in the European Union, where following the European Parliament adoption in early November, the EU Council has now approved the CSRD, Corporate Sustainability Reporting Directive. So this means that companies in scope will soon be required to publish detailed information on sustainability matters, including many large non-EU-based entities. So we're talking about more than around 50,000 companies in the EU, which count for more than 50% of the EU GDP. So a huge step up in terms of mandatory requirements. CSRD requires companies to disclose detailed information on societal and environmental impacts in line with the ESRS, European Sustainability Reporting Standards. And these standards take into consideration the input from the public consultation that also was held in summer. Now, the CSRD will now be turned into law in each EU member state in the next 18 months. And the EU Commission is consulting with some EU bodies before the final standards are issued as a delegated act in June 23. So similar timeline to what we saw before from the ISSB. The rules will apply between 2024 and 2028. And as you can see on the slide, they cover all the sustainability topics, not just a couple of them. Now, the EFRAG for the next year, who's been tasked to develop the second set of standards, will focus on sector-specific standards, in particular those covered by GRI, agriculture, coal mining, oil and gas, but also 5 high-impact sectors: energy production, road transport, motor vehicle production, food and beverages, and textiles. And will also include ESRS standards for SMEs. Moving on, in the US, following the release of proposed climate disclosures rule in spring last year by the Securities and Exchange Commission, which underwent public consultation, the latest information is that the rules are expected to be released in April, but there are no further insights on what's happening in there at the moment. And then again, moving on in the UK, in addition to the TCFD framework becoming mandatory for some already in 2022, there are a couple of other things to mention. First of all, the sustainability disclosure requirements, which were announced by the government in 2021. However, these have not been finalized, presumably in the wake of the ISSB standards, but also the transition plan task force, which was set up by upon an initiative from the UK government to be the first country to adopt mandatory disclosure of transition plans, net zero transition plans. And the task force has released a publication now and guidance on transition plans, which is now undergoing public consultation until February. In relation to the development and the disclosure of those net zero transition plans. As you can see, and then as we mentioned earlier, lots of other jurisdictions across the globe are adopting mostly TCFD as a mandatory reporting requirement. So we know about Switzerland, Singapore, New Zealand, of course, but then many other, of course, are very much watching what's happening through the ISSB as well. So there is clearly a great deal of work ahead of us, with key questions still being worked through, for example, on global harmonization of reporting standards, interoperability of different frameworks, and connectivity with financial reporting. Before we discuss how corporates are grappling with this evolving landscape, I'd like to invite Elodie, Sustainability Standards Manager from the Global Reporting Initiative, to join me to discuss GRI in a bit more detail and her perspective on where sustainability reporting might or should go next, and in particular with regards to something we just briefly mentioned, being nature-related disclosures and biodiversity. So welcome, Elodie. Thanks for joining us today.
Thank you for having me. Yes.
So starting with a question, Elodie, I guess I see there are some questions in the chat already, but we can go to those later on. So starting with you, I'd like to ask you, why is it important for finance team to be aware of nature-related reporting frameworks and standards?
Yes, indeed. So nature and biodiversity loss are issues that have received significant attention in the global sustainable development agenda. You may have followed the news recently, but it's been growing for a few years, and several key decisions were made in the past couple of months, which will really have implications for the finance sector. There's unfortunately very good reason for that, right? We're experiencing really a biodiversity collapse worldwide. You may be aware that a few years ago in 2019, the IPBES, so the Intergovernmental Platform, a panel on biodiversity and ecosystem services, issued a global assessment report, which really evidenced how biodiversity, this decline in biodiversity resulting from human activity. So we are losing coral reefs, all sort of ecosystem and species at really an unprecedented rate. And that really informed as well the global discussions around nature. In November last year, so for the first time, the COP27 on climate change in Egypt recognized that really deep interconnection on climate change and biodiversity loss. The final decisions mentioned the need to address both in synergy and stressed the importance of protecting, restoring natural ecosystems. And following that COP, in December, we saw the adoption of the Kunming-Montreal Global Biodiversity Framework at the UN Biodiversity Conference, so COP15, which is being held as the equivalent of the Paris Agreement for biodiversity, and that commits really the world to halt and reverse biodiversity loss by 2030. So there's 2030 is in less than 10 years, right? So it's really stressing the urgency of action that's needed. There are 4 overarching goals and 23 targets that were agreed upon to address the underlying causes of biodiversity loss. And there is one specifically, so target 15, that calls out businesses and financial institutions to regularly monitor, assess, and transparently disclose the risks, their dependencies, and their impacts on biodiversity. So then we see that really nature, biodiversity is a top priority, is becoming a top priority, and that a global biodiversity framework makes it very clear that accountability and transparency by companies, including financial institutions, is crucial. It's really part of the solution to address biodiversity loss. And so it's really important for financial institutions to embark on this journey, as you'll see that there are increasing expectations around biodiversity.
Absolutely, and thanks for framing that into the more kind of global context as well, with the recent developments. And in terms of frameworks and standards, Elodie, what are those that are emerging? What key disclosures are they asking for, and how do they fit together?
Yeah, so there are several key initiatives that have emerged recently that really aim to set the norms for assessing, for measuring, for disclosing impacts and dependencies of businesses. I have a slide, and maybe we can show that we'll try to summarize here in a visual way those for you. I think in the introduction that you made earlier, Martina, you mentioned some of those already. And I've added a few other that are also relevant, I think, for the audience here. And first, in the top row, you can see the methodological frameworks, initiatives, instruments that strive to define the global best practice for companies and institutions to assess, to measure their impact, to set targets, to identify the information that should be publicly disclosed. So you have the TNFD, so Task Force for Nature-Related Financial Disclosures. That's an initiative that aims to replicate the successful approach of the TCFD. So it's a risk management and disclosure framework to help companies to report and act on the nature-related risks, with the aim in the end to shift financial flow towards more nature beneficial, nature positive outcome, let's say. I've also included on the left the science-based target networks. They're really developing methods and resources that will help companies set a really science-based target for nature and climate change. Also here recognizing that interrelations. On the right as well, I've including one that's quite relevant here is the Partnership for Biodiversity Accounting Financials, so PBAF. It's a lot of acronyms. They've released methodological standards to support the harmonization of, which are the assessment methodology for the financial sector to measure impact and dependencies on biodiversity. And then there's the ALIGN project, which is short for Aligning Accounting Approaches for Nature, which are also published recommendation on what are the elements of biodiversity to measure, how to assess impacts and dependencies. So the TNFD draws upon all those initiatives or frameworks, and those in the end really informs the development of overarching sustainability reporting standards, so including the IFRS and ISSB, GRI, and the EU standards, for instance. There are key differences in these three standards. So I can, you mentioned already some of them, but I can explain a bit more. So I saw there was a question around a double materiality in the question, so that will hopefully also bring some clarity. So the GRI and IFRS standards, they are, we're developing standards, voluntary reporting standards. GRI really delivers the global baseline for voluntary impact reporting. So that is reporting on how an organization impacts the outer world, in that case, how it impacts biodiversity or nature. We are currently revising our biodiversity standards. We had disclosures around biodiversity since 2000, but now it was really the time to update them to really capture those latest developments that I just mentioned. We are working with everyone that's on this slide. So for instance, the PBAF and the ALIGN projects are in the multi-stakeholder group of experts that are providing guidance on the revision of our disclosures. We also have regular communication with TNFD and SBTN following their own development so that it can also inform our process. Maybe one aspect quickly that's also good to know is that our biodiversity disclosure are part of a topic standard that is sector agnostic. So it applies to any companies that have identified biodiversity as being material or important to be reported on, irrespective of the sectors. But complementing those topic standards, we also have sector standards that really identify reporting information specific to a sector. And we have one that will cover the finance sector, so including banking, insurance, capital markets, that is about to start. It would cover more than biodiversity, of course, but it will also help complement and provide very highly specific information to the finance sectors. Next to GRI, then the IFRS sustainability disclosure standards aim to set then the global baseline for sustainability related financial reporting. So it will more focus on what are the risks and opportunities for companies and how they would be then impacted by biodiversity loss or nature loss. And they've announced in December that they will add nature-related disclosures to the climate change standards. We have an MOU with them, so GRI and IFRS really aim to offer, to work together to really offer that complete and robust suite of disclosures, and in that particular case of biodiversity-related disclosure to assess corporate performance from this double materiality perspective. And then you have also jurisdictions that also have their own mandatory reporting requirements. And then the EU, as you just mentioned, are in the final stages of developing their own European sustainability reporting standards and E4 on biodiversity and ecosystems, really focusing on nature under the CSR directive. And we've also been working very closely with the EU. They've leveraging a lot of the GRI standard to develop their own content. And so that complementarity and interoperability between our sets of standards has been a key focus for all these three organizations in the past few months. And then at the end, I also mentioned that CDP and World Benchmarking Alliance, there are also key initiatives that then assess the performance of companies. So the information disclosed by companies can be used to assess the performance through surveys, through benchmarks. So that's also what they do. And they can also provide that information. So that is in a nutshell. I'll stop here for now, but that's in a nutshell what are the key initiatives to be aware of. A lot of them are still in development, so that there's also an evolving space.
Thanks, Elodie, and I think that's very helpful. Thank you. There are a couple of questions in the chat. One is about the timeline for when TNFD or equivalent disclosure will become mandatory for listed companies. Now that will depend on your jurisdiction. Because if you are quoting to the scope of CSRD and you're a listed company already in scope of NFRD, you may be required to disclose on that already next year. And then therefore it's very difficult to answer this question without knowing which jurisdiction it is. Also, even if it will be on the frameworks adopted will be ISSB, again, that will depend on when your jurisdiction will endorse those as mandatory in your country. Yeah. Another good question, however, is around where have you seen best practice for TNFD or equivalent reporting and disclosure so far? Which companies are doing well? And more importantly, from my end, is what are the practical considerations in reporting against these frameworks, including challenges, and how can they be overcome?
Yeah, so maybe a couple of things. And I mean, if you want to look at practical examples of companies, you can look at what the World Benchmarking Alliance is doing. They just released end of last year their first assessment. So they assessed, I think 400 or 500 companies. So you can look there, their benchmark exercise and the outcome of their benchmark, and you'll find some examples of companies there. So maybe that can also help you find some how other companies or your peers are doing, and that's an ongoing process, so they will also assess more in the coming years. And then maybe some practical consideration to have in mind when you look at all these frameworks and some of the challenges is that, first of all, I think it's important to stress the difference between a framework and a reporting standard. So, institutions would need to report against reporting standards, so either voluntary standards or also the mandatory requirement under the legislation you fall under. TNFD, for example, is a framework. It's not a standard per se, so the work influence the work we are doing as a standard setter and probably the work of several legislation, but they are not meant to be per se the conduit or the tool by which company would do the reporting. And if you talk to them, the lifetime of that initiatives is not defined, but that would very much depend on how the different standards and mandatory requirement will take on their recommendation regarding disclosures. So. Then it's also important to understand that, especially if you look at the voluntary reporting space, or different reporting standards complement one another. So as I just mentioned, as GRI, we're really focusing on the impact that an organization has on the outer world, while if you want to have more information on risks and opportunities, then look more at the IFRS, what would come out of the ISSB disclosures. I guess in terms of challenges, there are a few that are really inherent to the topic of biodiversity. So just going to mention a couple, but it's a challenging topic because unlike climate change, there is not one single unit that you can use to measure your impact and dependencies on nature, on biodiversity. You can't translate everything into an equivalent of, a ton of carbon equivalent. If you impact an ecosystem in country A, a threatened species in country B, then you'll have to, you can't measure that in one single unit that will help you track biodiversity loss over time. So that's also why all those initiatives that I just mentioned, like TNFD, Align, PBAF, are looking at how you can measure your impact and dependencies in a way that is still feasible for companies. It's also very important to know the location of your impact and dependencies. So again, like climate change, it's very different than climate change, for instance, where it doesn't matter where the emission come from, it leads to a global change in climate. In biodiversity, the same activities can have a very different outcome or impact, whether you're located in a highly biodiversity sensitive areas or not. So that also add a layer of complexity, and that's also where those methodological framework think about how can we help companies to prioritize, to identify the location and prioritize where they need to put focus on. So so that's one thing. And I guess as well, one of the challenges is the availability of data. So if we want companies to look at a supply chain, for financial institutions to look at their portfolios, it's sometimes difficult to have very precise information or data. So again, that's where there's a lot of work doing in that space. So then you look, for instance, at life cycle analysis or footprinting approach that can maybe not being the most accurate, but are a really good first step to help companies identify where are the hotspots in terms of impacts and dependencies. So, and also, when you look at a reporting per se, we have mechanisms in place, for instance, in the GRI standards that will help companies to improve, to gradually report and improve their reporting over time. So we really look at that as a continuous improvement. Even if there are data gaps, you can start reporting using our standards. So that's also something to keep in mind.
Thanks, Elodie. I think that's been very helpful. Great overview on what's happening in the biodiversity and nature space. And so thank you for the insights. Now, I wanted to move, conscious of time, I wanted to move to our next speaker. So I'm delighted to welcome Saad Malik. Saad joined National Grid in 2022 as the Group ESG Reporting Lead, responsible for developing the group's ESG external reporting strategy for all stakeholders, from investors and lenders to customers, employees, communities, charitable organizations, and suppliers. So quite an interesting role you have there. Can you begin by telling us about how National Grid currently reports on sustainability-related information? What is being reported on? What is the role of the finance team?
Yeah, absolutely. Hello, thanks for inviting me to speak on this. So yeah, I mean, National Grid, I would consider us now, global sustainability reporting leaders or among them. And yeah, as you in your introduction, I think the key thing is to provide relevant information to meet the objectives of all stakeholders. Investors want to make good capital allocation decisions, but all of those other stakeholders have their own reasons and decisions to make. And this is additional information that they need to be able to make those decisions on your business. It's that double materiality point that Elodie made, that it shouldn't just be from one, it shouldn't all be from one kind of lens. So on that point, we, in terms of our sustainability reporting, we have our responsible business charter, which is our strategy. And that is kind of a very business specific strategy. National Grid has these kind of operations, so we will report these metrics against those. The only issue with that is that when you think about what the objectives of sustainability reporting is, or are, it's credibility, reliability, comparability, and decision usefulness. And when you're reporting against your own strategy, sometimes the comparability isn't there. So what we do is we also report against a number of major established frameworks and standard setters. So we actually report against the TCFD, the GRI, and Elodie will be happy to hear that it's in adherence with and not just in reference to with the GRI. We report against SASB, and we actually, interestingly, report EU taxonomy fully aligned disclosures, and we were one of the first companies in the world, I believe, to actually do that last year. Just have a go at it. It was voluntary, and a lot of this stuff is voluntary, as you can imagine. We don't have operations in the EU, but we agreed with the objectives of that. So there is a reason for us reporting against each of those. So TCFD and SASB, we know that, number one, it provides really good information to financial stakeholders, but beyond that, it is it's future-proofing us and preparing us for the ISSB future, and SEC proposed rules and things that are kind of based upon those. GRI provides that information, the double materiality information, and the wider not just climate. It gives us an early ability to provide that information to about wider sustainability issues, and also to a wider stakeholder group. And we're also doing the TNFD readiness, and also looking at the GRI 304 standard, and also kind of getting involved with the SBTN as well. So really trying to, I think we've developed a culture of early adopting. It's set us up well for what looks like a very kind of complicated and interesting mandatory regime that's coming up. And I think that we're set up in a way that now we feel quite confident, but there's a lot of work to do. We know that if we kind of stagnate for a little bit, everyone will come and surpass us, and we really want to be at that kind of front end, so that we're not at risk of any of greenwashing and a lot of the other things. In terms of what finance do, we're responsible for setting the reporting strategy. So what we do against each of those major established frameworks, but also so what to report against, when, and to what extent. We also own compliance, completeness and accuracy, assurance coordination, leveraging our knowledge of processes, controls, and technology. But there is that point of, I think sustainability reporting is a heavy collaborative kind of process. You can't do everything yourself. You can't do much yourself. You need, and that's very unlike any kind of other process. It can't be siloed. It has to be a group effort. But I think that in finance, where I sit, we are quite well placed to kind of implement some rigor to the process, but also be really collaborative. And I think that you need to have both of those and be quite strong at both of those to bring important points of view, and also the expertise of others in your business. We also have a consult role, and a key consult role on areas that are owned by, for example, our Chief Sustainability Office function, such as the sustainability strategy and running the double materiality assessment. So yeah, I think that kind of is our overview of what we do.
Yeah, no, thanks, Had. That's helpful, and it clearly shows how to be a front runner, leader in that space. You need that approach, really 360 degrees involved, people and teams involved in that work. I guess Elodie earlier touched on the challenge around data, and obviously every time we speak about sustainability reporting that comes up. So of course, a question to you is around that. Of course, the standards are not taking that away. So how are you tackling this challenge?
Well, data is a big challenge because this is, I think, even if we could consider ourselves leaders, but I think everyone is quite immature compared to, for example, financial reporting. And data is a big challenge because I think historically this information has been useful for certain processes or certain things, but not probably to the extent that it's becoming important. And so that data probably hasn't had the kind of the level of control around it, the level of processes. And when I think about like, greenwashing, there's accidental greenwashing, and then there's obviously the nefarious kind. And I think a lot of organizations are probably, in many respects, apart from a small group of ones that have other challenges, but I think a lot of them are worried about the former, the actual, like, what if we make a mistake because of our data issues, we add a zero where it shouldn't be, and suddenly the number is materially wrong. So, I mean, at National Grid, I've been given that role of kind of owning and making sure that we can get to a point of being ready for this mandatory future, and with a focus on data quality and availability. So, I mean, I've started a number of work streams. So one of them is the data governance project, which is kind of making sure that we have like a really good oversight of our data inputs and our data sources for every single metric. So we actually report like over 170 odd metrics in sustainability reporting, and almost like tracking every single one of those back to its very, very first input, and then overseeing that process and mapping it and getting to a point where we can then identify any kind of gaps and weaknesses. The other is around reasonable assurance readiness. So again, we know that the world is moving from a limited assurance regime to reasonable assurance. And I think that the standard setters are giving us a lot of time for this, and we have a few years, but we do want to get ahead, make sure that we're ready for it as well. So we are setting ourselves a bit of a challenging commitment and objective there to move to that new regime. But we don't want to move into that regime where our external auditors are suddenly like charging us 5 times what they're charging us now, and the resource requirements are 10 times more. We're trying to apply that kind of controls-based audit mentality where we can actually really improve our processes, controls, technology in the space of sustainability information, to the point that then when we get to a reasonable assurance regime, our assurers can hopefully rely on a lot of those controls and this mature controls environment, to the point that they don't need to do as much substantive and heavy auditing that they may have done if we didn't have that. So in order to do that, there's a lot of work that needs to be done, building risk and control matrices, building a risk management framework for it all, and kind of building backwards. Now we are piloting that project for scope 1, scope 2, and our diversity metrics, because those are the ones that we think are very kind of, very material. And also there are some complexities involved, particularly in the former two. So that's the other one. We are also, implementing an ESG reporting platform, and these kind of systematic things that we're implementing. I mean, the other thing is that we built ourselves a carbon calculator, which kind of addresses some of the early stuff, and then the ESG reporting platform. And what that does is it'll hopefully bring some kind of automation to the process, reduce your manual processing and your manual kind of manipulation of data, because the more you can do that, the more in better shape you'll be. I think the challenge is kind of data availability then. So are there any gaps in your data that you just don't pick up at the moment, and how do you manage that? And so we are taking steps, and an example is a third-party waste provider that we would then input in the contract that you actually have to provide. When you pick up our waste, these are the 6 or 10 things that you need to provide us as data, and so we're trying to address any of those kind of gaps in our knowledge from a data perspective. And for example, we actually don't bill ourselves, but we provide our own electricity in the US. And so there's not a great deal of metering in that in some of those operations. So we're trying to kind of develop our processes there to improve that. And all of this is kind of transparently disclosed, but they are challenges that every business will have, and we're trying to address them in that way.
Thanks, Ad. I think that's, it sounds really logical, but I'm sure it's very difficult to, to implement.
Absolutely, yeah.
So well done. Thanks for that. You mentioned assurance. You mentioned also how you're selecting those metrics that are undergoing assurance first. So scope 1, scope 2, diversity metrics. So there was a question around your approach to assurance, which sounds like you've covered already. So thanks for that. You referred to greenwashing, so just one last question for you, I guess, before we wrap up. How are you trying to mitigate the risk of greenwashing while trying to meet those stakeholders' expectations on climate action?
Well, in one way, I'll kind of half answer with the assurance point, because up until now, actually, I mentioned that 175 KPIs we report against. Almost half of those are, actually no, 70% of those now, I think this year, will be externally assured by PwC, who is our kind of external assurer, at a limited assurance level, but that's how we manage it. And then we have a second line of defense who kind of test everything else, and they almost act like an independent assurer. And that's essentially how we manage it. And I think that kind of allows me to kind of sleep better at night when we're thinking about greenwashing. The good thing, I think, is the important things from greenwashing is culture and values. Like you need to have a business model where you're not doing this stuff to tick a box or to make yourself look good. You're doing it because you really want to provide transparent and real information. And the second you're trying to do the former, you're trying to just provide what looks good, you're already in that mindset of how can I make things look better? And that's that nefarious aspect of greenwashing. The other aspect, and I think that we have a really good culture, a set of culture and values that are kind of trying to provide, and I think it comes partially from, we have really important stakeholders that we would be in a lot of trouble with if we provided information that's not credible. So it's really like a really important thing for us to be really honest and transparent with the information that we disclose. But the other aspect is, what if you get it wrong? What if you kind of miss something and there's a really material aspect of your scope 1 that you actually didn't even include in your calculation and things like that? That is the aspect of, and all of these projects that I spoke about. And we actually really get close to, you know, the upcoming standards and the ISSB and the TNFD and all that kind of stuff. SEC proposed rules is relevant to us, but I actually keep a really close eye on the ESRS as well. So everything that is on the horizon, TPT, we are taking stock of it, building up an understanding of what are the requirements and how does this affect our business, so that there's a completeness view on that, so that we're not missing anything, and then building up, you know, a kind of a data governance structure for that. Now, this takes time, and it's not an easy thing to do. As you mentioned, there's a lot of collaborative effort that needs to go into that. But I think that those are the things that we do. Those projects around making sure our data is good is a really key one, and then getting the culture and values right.
Thanks, Ad. So I'm conscious of time, so I must move on to our next speaker. But thanks a lot. There is a lot of food for thoughts there. You mentioned the data governance, the reasonable approach to reasonable assurance. You mentioned the culture. So a lot of tips for our audience on things they can start looking at and working on if they haven't yet. So thanks for taking the time to speak to us today, Saad. Now, I'm delighted to welcome Daniel Clear. Daniel joined the ESG Book as Chief Executive in June 21. And ESG Book is a leading ESG data and technology company with offices in Boston, London, Frankfurt, Delhi, Singapore, Tokyo. I hope I haven't missed any. So prior to this, Daniel was Global Head of Sustainable Finance for HSBC, where he developed the global climate strategy for the bank and led the sustainable finance business across the organization. So I'll hand over to Daniel to present to us his perspective and his insights in terms of what's happening in the markets, also from an investor perspective. So what are you seeing, Daniel, from your end? Thank you.
Martina, good morning. Thank you for having me. And Saad, thank you for this piece. Really, really insightful. And I recognize all of the challenges and great to hear the progress. So thank you for that. Very briefly, how did I come to all of this? I've been essentially a user of ESG data as in my role at HSBC. And frankly, I was sitting on a panel every week complaining about the lack of data. And so I thought I need to provide an answer. And so I moved over to run ESG Book, a 4-year-old company, about 1.5 years ago. And I won't tell you too much about the business, but just one slide up front. If you move to the 3rd slide, I think. Perfect, thank you. Just who we are a very large ESG data and technology provider. We cover about 37,000 companies with 450 ESG data points. We turn data then into insights. So we run obviously ESG ratings and scores, ESG risk metrics, human rights scores, and increasingly the biggest areas of demand are climate solutions, so net zero alignment, climate risks, and obviously how do we help companies and investors comply with regulation, because complying with regulation is just a data problem. And then finally, we have a technology platform, 95,000 corporate disclosures on platform now, which is actually free to use in its basic version. So any one of you can sign up, esgbook.com, sign up and join the community. We have 15,000 users now on platform. Won't go through the right-hand side, but you see the kind of institutions that we work with. We predominantly help large investors understand the ESG profile of their investments and help them align. But we also work increasingly with companies to respond to the increasing ESG pressure. So if you move us on, I wanted to cover 3 things. I wanted to cover for a minute where we are with ESG in the financial institution space. Second, go into what are the challenges, and then give you a brief outlook. And I'll try to do all of that in the remaining 11 minutes. So if you move on to, well, something happened with the slide pasting. Move on to the next page. I think something in the formatting happened when we transferred the slides. But very briefly here, I don't need to tell you, sustainability in financial markets has seen a significant increase, and it's driven by 3 things. Obviously, investors have made big pledges. The 2 biggest ones are the UNPRI, so the Principles of Responsible Investing, 120 trillion at the moment signed up to integrate ESG characteristics into the investment process. And the second is the Race to Zero, so the net zero pledges that were made in Glasgow, which again was made by about 130 trillion dollars of investment capital. The second is regulation. No doubt, regulation is the main driver to move this industry forward at the moment, because it means everybody has to move at pace. I'll come to some of the challenges because we cover at the moment about 3,700 different policy interventions in the world, which clearly is a lot. And then the third is real capital moving, right? Corporate action. I put a number here, a bit more than 1,000 large companies have now signed up to the Science Based Targets Initiative. Similar numbers on TCFD. The numbers are still small, but the large capital, so the large companies in the world are moving, and that means obviously their supply chains have to move. If you move to the next page, I wanted to give you, we lost the page. Shall I share? No,
I'm just switching to your version of it, Daniel, so it'll look right. Just give me 2 seconds.
Don't worry. I wanted to give you page 6, just an overview. How are financial markets actually using ESG data? So if you move to slide 6. Perfect. So when we think about ESG use cases in financial markets, there isn't one single use case, nothing, which is part of the problem, right? It ranges really from people that are looking for non-financial data to pick companies that will outperform. So essentially alpha generation performance. We have a big use case on transparency and reporting. Obviously, if you want to comply with regulation, a big focus of ESG in financial markets is risk management, right? How do I avoid tail risks? But then I also have a big community that looks at outcomes, impact, integrates it into research and stewardship. So a very, very broad set of use cases why ESG data is important for financial markets, but also means that people are looking for very, very different elements of it. One of the reasons why I think the single ESG rating and the single ESG score will disappear in the future, because you can't address all of these different use cases with a single metric. That worked in credit ratings because credit ratings tell you how likely it is that you will get your money back. It doesn't work in ESG. And that brings me a little bit to the challenges. If you move 2 slides forward, I see 6 big challenges here in the space, and I won't go too much into detail. The first 2 are big political and societal issues. We see a massive ESG backlash, especially in the US, where ESG is becoming really a dividing line between parties and states. You've seen many treasurers write to the large asset managers saying what they're doing is illegal. We have received a letter from the chair of the banking committee calling for changes to ESG scores. So it's becoming very, very political. At the other hand, you have obviously a significant rise in what people would call greenwashing allegations, including fines. You've seen European asset managers, but also the SEC intervened with a number of the US asset managers to increase the quality of what people actually put behind an ESG label. The second row down is I think a data problem. We have a lot of inconsistent standards, and I'll talk a bit more about that in a minute. And we have a lack of data, and I'll talk a bit more about that in a minute. And then the last bit is how people are using ESG data. And I think the 2 big shifts that we're seeing at the moment is the move from exclusions, where essentially ESG meant I'm not investing into tobacco and alcohol and controversial weapons, to real integration into the investment process, which is much more complex. And the second piece is, how do I move from target setting and promises to actual execution? Right? Setting a net zero target is a challenge, but actually delivering it is much harder. And let me just take you to the next page. I have a few little bits that support what I was just saying. One thing is clearly the complexity of ESG standards. We have at the moment a database which is called the Reporting Exchange, which we developed together with the World Business Council for Sustainable Development, which tracks 3,700 different sustainability standards. And what you see on the right-hand side is the overlap between the two, between sort of the dominant standards in the world. And you see that the overlap isn't that big. So between GRI and SASB, 41% of indicators are the same. That's not bad, but also means that 60 indicators are different. And that's one of the best metrics on this slide. You see many other areas. The overlap between WEF and SASB is 9%. And so the more we have new acronyms creating different requirements, the more obviously companies are confused. The second problem, if you move to the next slide, is we have significant data gaps. So I looked here at the 10,000 largest companies in the world. We now have pretty good disclosure on scope 1 and 2 emissions. We have pretty good disclosure on, say, women on the board. If you want to look at complete TCFD disclosure, less than 2% of companies in the world do this. If you look at things like water stress, 4% of companies do this. So yes, there is a good discipline evolving in core metrics, but if you look at the wider range of metrics that we would consider relevant for broader ESG assessments, and especially when we talk about biodiversity, which we covered earlier today, we have a significant gap in current disclosures. And if you just look at the next slide, then I'll stop with challenges and I'll give you a bit of an outlook. At the moment, we obviously have a very significant gap between what people say and what people actually are able to deliver. So we looked at companies and their climate commitments, and we looked at companies that are aligned with a net zero pathway. In Europe, that is looking pretty good. In consumer goods industries, for instance, on the right-hand side, that is looking pretty good. But you look at energy minerals, a lot of the technology services, a lot of the companies outside of Europe, up to 3/4 of the companies are not delivering on the targets that they have set. And that is a challenge, as obviously we now need to look at 8 to 9% carbon reductions in an investor's portfolio every year if you want to align with a pathway. And that means the investable universe is becoming significantly smaller every year if you want to stay true to your commitment. I know we're running out of time, so let me give you just a quick outlook on two slides. First one, for me, there are 3 big initiatives to watch. We've seen many logos today. The 3 ones that I watch is the European CSRD, the new rules that are coming out of the SEC, and ISSB. There's still room, I think, to align these 3 much more, because you see on this page that the focus of the 3 is still very different, both in the way they think about materiality, CSRD double materiality, ISSB and SEC predominantly enterprise value, the scope, and whether it's industry agnostic or industry specific. So those are the 3 for me to really watch. We will see significant progress this year. And I'll end with one little page, if you move to the next slide, how I would think about the move from ESG 1.0 to ESG 2.0 and how I think financial markets are looking at this more and more. If you look at the world today, we manage ESG portfolios with single scores that try to integrate everything. We base it largely on backward-looking data. We have data mostly for public markets in developed markets, and the approach is very risk-based and exclusionary. Right? So I try to avoid scandals. I try to avoid certain activities that are seemed unethical. ESG 2.0 is very different. It's very data-driven. It goes down to a raw data point. We're trying to look a lot more at unstructured data to give us forward-looking information. It's a much more holistic coverage between public and private markets and a big focus on the global south. COP28 this year in the UAE will put a big focus on the global south and the role of the south in the broader energy transition, but also ESG more broadly. And then I think we see a much more significant integration into the actual financial decision-making process rather than an exclusionary approach to in the end deliver outcomes and better returns. So for me, we're at a quite pivotal point. Data sits at the heart of this, and that's why the initiatives that we just talked about in this session is so important. And I think what the other panelists said is we essentially are moving from a world where this was, frankly, storytelling to financial-like data. And that's a very significant shift for the companies that we work with, and I think many of the people on the call. Let me end here. Happy to go deeper into this probably in another session because I see it is 9 o'clock in the UK. Martina, back to you.
Thanks so much, Daniel, for also being on time. Just one question for you, if possible. What would be the one key thing you would ask finance practitioners working in this space, if you were able to select one?
My key thing is take ownership of this, right? For me, the main question that I ask companies is, where does this sit? And as soon as I hear it's in communications or it's still in the, let's say, more traditional sustainability team, I know there's work to do, right? In many organizations, the finance team is taking a very significant role in this because they've built up rigor over decades how to run essentially data sets and report. So I think that partnership is incredibly important, and we don't see it in all of the companies yet.
Thanks, that's very helpful. And of course, finance teams are at the core of translating whatever data you might get into decision-making in the end and drive that as well from their core central role. So that's very helpful, thank you. So thank you, Elodie, Saad, and Daniel for giving us such detailed insights into corporate sustainability reporting and how you're approaching these challenges faced. To all participants, you will receive links to the most relevant and useful resources in an email after this webinar and to other resources that were mentioned. The recording of today's session will be available in a week's time and will also be shared with you via email. Of course, we also hope that our webinars not only provide you with information, but also allow you to explore what you personally can do to put this knowledge into action. So I'll stop here. And as we run similar webinars regularly, we're keen to get your feedback to help us make these as useful as possible. Thank you again to our speakers and to all of you who have dialed in, and we hope to see you again soon. Thank you.